Welcome back, episode 73 of the Ground Up podcast.
I've been up since 5 a.m. yesterday. Don't try this at home, kids.
I'm actually hosting the Property Investor Awards this year.
You'll definitely win coolest service business of the year.
Thanks, mate. I don't know if it's a high bar, to be honest, but betting on the pound going down in value. Quantitative easing is going to come back in droves, but ultimately time in the market of asset holding when we go through a bad market is the game to play.
You want to increase your debt position as much as possible.
Developers have a really bad reputation. I think the general consumer thinks that we're capitalists.
We're trying to make a margin on the economic environment. That's what we're doing as business owners.
They point the finger at us. What about pointing the finger at all of the supermarkets that had their biggest years through COVID when people needed food and water?
How much do you reckon I have to buy in government debt to have a seat at the table?
Fucking all of it, mate.
You can live in my life in the Bitcoin world.
Before we came on this episode, Stuart said, I haven't got anything to talk about today.
Well, I'll talk about Bitcoin.
Ground up sound, ooh, yeah. Real estate deals. We lay them down, let's get those deals. Deals, 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 making money, baby.
Welcome back, episode 73 of the Ground Up podcast. Now, if you don't know who we are, we're four property developers based in the UK. We run development businesses. We run other types of service businesses as well. And we operate the four corners of the UK, pretty much from the northeast to Wales, the home counties and London. And every week we get around the mic and we chat shop about business, property, the markets, politics, anything that we think may be useful to our space, but also that we're just sort of idly interested in. So if you like this kind of content, make sure you subscribe, share the episode with anyone you think may find it useful. Big love. We've got Jack Jiggins, Stuart Wyeth, Dorian Payne, who's heading back from London currently, and myself, Ryan Beaumont. We are the Ground Up Podcast. In this episode, we're going to be talking about what can you do in this market of doom and gloom and a bad economy? What does it mean for investors? You know, is your investment still going to be worth it in the property space? And what are your alternatives if you have money? What can you feasibly do with it to make good returns? We're also going to talk about award ceremonies and whether awards are good for business owners or not. And we're going to talk about university as well. Is university a useful spend of time for young people now? Or should you just get straight into the workplace? So this will be a good episode talking about money, finance, investors, returns. So enjoy. Big love, subscribe. And don't forget, we have got a go-karting event coming up. The go-karting networking event soon. So make sure you check the link out in the description of this YouTube video, or you can check out the link in our bio on Instagram at grounduppod. And you can look at any future up and coming events we have. And the go-karting will be a great one. Networking day, do some go-karting, have some fun, chat shop, meet some new people, and go for dinner afterwards. So yeah, big love. Subscribe to the podcast. Let's get into it.
Good to have you back, Roy. You feeling a bit better this week?
Yeah, mate. I mean, how did it go last week? Was it all right?
The intro was beautiful.
Do the intro again, Jack. Do the intro.
Jack was rough as a dog. We had about three goes in it, and yeah, it was all good. Oh, it's all right. Missed you, though, mate. First one we ever done without you, I think.
I know, mate. There was one before. I don't know if you remember. There's another one. I think I joined towards the end, and you guys were doing like fucking turkey sounds or something at the start. Something fun. But yeah, no, mate. Last week, like, I don't mind having a cold or something, but I just had this splitting migraine all night, and it happened to me throughout the week. I had a bit of a man flu fever thing, and there's just no way I could have got on the podcast with a headache. I don't mind if I'm sniffly and that, but I was just like in bed, like, oh, I just can't move my head.
To be fair, man flu is like, I think, scientifically proven to be one of the hardest things to deal with. So
worse than pregnancy.
yeah.
Like, the bigger we are, the
Amount
harder
of
we
down, man is down. That is the
Man
problem.
is
Down.
down.
Exactly.
It gets you.
Exactly.
So yeah, it was pretty brutal. But anyway, back this week, episode 73. We're cracking on. How's everyone's weeks? I mean, D, you've just come back from an awards ceremony, haven't you?
Yes, my friend. It's been a long one. I've been up since 5 a.m. yesterday, and I went to the gym, went to the office, went to London. Well, I drove to Reading first to get to London, and then actually went to a golf club in Reading on the way in. Went to the driving range, got set up on the driving range. Ball machine wasn't working, and the guy was like, "Yeah, you have to go and pick up your own balls." I've got it on video as well. So as I'm walking up the driving range, I fucking with the basket picking up balls. Yeah, unreal. Anyway, but yeah, went to London because I know I'll send you the clip. But I was a finalist of 2 awards for the Construction News Awards. I was a Rising Star finalist and also a Specialist Contractor finalist. And fortunately, I won the Rising Star Award last night, which was good. And we partied the night away. But because I don't drink, because it's very late, I had like 5 Red Bulls, 1 espresso, three coffees, all past 9 p.m. So I just could not sleep at all. So I've been up since, and now I'm driving back home.
Right. Well,
Have you got a
both
full
on the drive? You're not on your phone. It's in the cradle, right? So
Great. Looks like it.
Yeah,
Stick it away.
hands free. Yeah, I caught the 5 a.m. train back from Paddington. I'm going now home. I'm going to take the kids to school at 8:30. Then I'm going straight to the office. Got a full day ahead of me, meeting after meeting. I'm already 1 coffee down, probably unhealthy lifestyle. So don't try this at home, kids. But this is the realities. Trying to cram everything
what it
in.
takes.
Yeah.
It's what it takes to run a business. To win all these awards.
What do we think of awards? Like, I know we spoke about them before, and D, I think they're good for you because you're dealing with a lot of corporate clients, people who really want to see accolades and stuff like that. But what do we generally think of awards, Stu?
I'd like to win a few. I just can't be able to apply for any. I mean, they're okay. I mean, some award ceremonies are all fixed. They're all internal circles, and they already know who's going to win. It depends who's actually giving the award. If it's, I don't know enough about them, to be honest. I've never lived in a world where it matters too much. Would I like to have a shelf full of awards? Yeah, of course. Who wouldn't? But will I go out of my way? Do I value the time it takes to go there, do the all-nighters, drive all the way home, feel shit the day after? I don't know. They're all right. They're good.
Old Stu would have loved that excuse to get pissed up.
Yeah, exactly. I'm too old for that now, mate. I could
Bring back
it makes me
old
feel
Stu.
sick thinking about how Dorian's feeling right now, to be honest. Oh, an all-nighter, rough.
I bet he feels better
And
than
then
I do.
the pressure of getting on with the following
I
day.
feel
before-
fantastic. I feel fucking vexed.
Yeah,
Go.
I'll give you a shout about 3:30 this afternoon. I bet you feel rough.
Yeah, then I will be.
You feel bad.
So I think so we've won some awards in pretty much all of our businesses apart from XP Surveys now. So I think winning a award to get you off the start line to say you're an award-winning company holds really good value for stakeholders, investors, and just general well-roundedness for marketing, PR, etc. So I do think it is worth exploring. We are kind of at the stage where we have won awards. We know we can win awards, and actually, the more important thing for us are our numbers and how our business is performing. So we have definitely gone down more Stuart's route in that we don't really need to keep banging that drum every year. We're not like Dorian where we want to run a national business and keep on that trajectory where our sort of I suppose accolade and trophy cabinet is growing. So I do think it is good to get one off the mark. And then secondary, I do think awards are really good for actual people that don't understand what you do, that are close family and friends, to see you get recognition in your field. Because when you're a busy fool running around and doing a load of stuff and and your sort of friends and family don't really understand it or have the time to sort of go on your site days or walk around the sites and understand it, I do think it is good for them to sort of go, wow, they've actually become top in their class for that particular award or that particular award in their field, which is equally quite good. I'm actually hosting the Property Investor Awards this year, which is where we won awards before, and I do think it does help. Like, for an example, one of our investors on Colney Hatch Lane, who invested 7 figures into a property development deal, found us because we won an award for Deal of the Year. We then got invited on a podcast to talk about that deal. That then went up on someone else's podcast platform, and then he then found us on that platform, reached out to us and said, I've seen that you won this award and that you've been interviewed. Can I meet up with you? We met up with him, and then within literally like under 6 months, 1.2 million quid invested in a project. That is obviously a success story, and there are, you can win an award and not raise any capital. And the reason he raised in capital is because he trusted our business, who we are, where our numbers were. He liked the deal, so there's a lot more that goes into that. But I think that was the original lead that came via that source. So I do rate them. I think they're worthwhile. And like Stu said, I think you've got to do your sort of background. There's to give you an example, there's a lot of awards out there that are just a pile of shit. Like Ben gets like letters to Aura saying you are now Employer of the Month. All you've got to do is pay £350 and we'll issue this award. And there's no entering, there's no competition. It's just a company that's it's basically a PR company that contact businesses just to get accreditation. So that is a little bit of, you've got to know where you're at in the market space and make sure that it is a proper outfit. But like the Property Investor Awards, there's something like 100 judges now. When we won our award, there was something like 450 people that submitted an application to win an award. Now that is properly winning it in your industry, and collecting in that space. So I rate it. I get what Stu's saying. It is a lot of work. We've applied for a lot of awards, and then if you don't win them, you're like, fucking hell, that was hours and hours of the team and us pulling together work, and it is quite painful.
I just the thing is with awards is who are you trying to prove? Who are you trying to prove to? You know, who cares if people think you're good or not? I look at some of these award winners and think, fucking hell, awful deals. Or I just honestly, I look at fuck me. I wouldn't even want to be recognised with that award as it anyway. And then I look at the judges that are judging and think, fucking hell, like really? You're the guy that's judging these deals, like, or the woman or whatever. So I don't know. I just think it's all a PR stunt. It's all a way of making money out of people who are in the industry.
It's a fucking conspiracy, Stu.
It's a conspiracy. Yeah, they're all in it. Nah, it is what it is. I mean, it's good. Some of the bigger ones are pretty good, but you've got to spend the hours doing it, really.
I don't get involved in any of the award applications or submissions. I didn't. I have a team that does that. Mia mainly does that on behalf of the business. And this one, construction award news. I agree with what everyone's saying.
Your rainbow, whatever the saying is, congratulations on that winning your award. I'm sure this one was a good one, but in general, there's a lot of
Half the views are slagged
Ground
up
Up Award.
completely.
Ground
Yeah,
Up
well
Award.
done.
Each other one each. We'll all pay each other £200 to enter, and then we'll pay £100. You have to pay £100 to judge it, and then once you win, you get a nice Ground Up Award. Congratulations! Then you're award winner. That's basically how it works.
Yeah, I generally follow the same sentiment as Stu, really. Like, I think people winning awards is great, and I agree with Jack and everything he said is good for accolades, and I think it's for Dorian, especially with his ambition. Trophy cabinet's always going to look good for him because he's having to deal with a lot of corporate shareholders or stakeholders, sorry. And I think that makes a lot of sense. For my business, I just think, what would I win an award for? I definitely haven't done the best HMO in the UK. Definitely haven't done the best commercial to residential deal. I'm just chugging along, building my business, and I don't know where I'm worthy of winning an award of notoriety in my sector. Therefore, I don't feel like I should win one. But that's just my personal view on it. And also, it is a bit of effort in it going to an award ceremony and doing all this stuff. I'm just not that developer, that's doing like a flagship development. Whereas I think Jack and Dorian have definitely done some flagship stuff, and Dorian's obviously doing serious scale. So it makes sense.
You'll definitely win. You'll definitely win coolest HMO service business of the year.
Thanks, mate. I don't know if it's a high bar, to be honest, but thanks, mate. I'll take that. Coolest HMO developer.
Yeah, you just invite the judges to your frat house of a HQ you have, and
Come
give
on
them the
now.
time of a Darlington life, and you will be winning.
Fucking right. But yeah, sweet. I mean, that's awards. So I got another one for you guys. All right, here we go. We're fucking ad-libbing today. So I had to do a video recently to send out to our database. We've got about over 4,000 investors in there, and I wanted to illuminate, because we get a few questions that come through from particularly more novice investors who go, but what about the market right now? What about interest rates? What about inflation? What about the renters' rights bill? So I did a video, 11-minute video, kind of discharging these concerns by going a bit more high level with it, which almost is going kind of fundamental layer. And I went, okay, let's look at the difference between retail investors and smart capital allocators. So your big institutional funds, your BlackRock, your Blackstones, Granger Group, Lloyds, etc. What are they doing with their money? And what is the media fear mongering the average retail investor on? And when you look at it, essentially, retail's getting scared like they always do when there's bad press. And then smart capital swoops in and just buys up everything in droves for a discount and dollar cost averages those purchases into a downturn market. And then we wonder why asset holders end up consolidating to the top few companies and not the small few, because generally retail listens to market sentiment, which can be distorted, not necessarily data driven, and sometimes misses the mark on why actually UK property is good right now. And my whole thesis was around the pound, and they were betting on the pound going down in value, which is going to happen because they have to print more money. Quantitative easing is going to come back in droves, in which case that debases the debt value in an asset base like property, and therefore you by default grow your equity portion over time, because the pound, the property is going to get valued in more pounds, but the debt as a fixed sum is going to get devalued as the pound decreases in value. So your equity sum grows. And I basically did a video around that to try and educate our investors on, yes, you may think that because rates, because this, because that happens, but ultimately time in the market of asset holding when we go through a bad market is the game to play, because that's what all the big boys are doing, and that's why they're buying up in droves. So that was my sort of whole thing. But I wonder what you guys think on either that sort of thesis, but also just where you think money is to be made in what could potentially be quite a difficult market we have coming up. Not necessarily the property market, but the economy is going to be quite difficult. How would you rebuttal investors who may be fearful right now of, okay, we're going to head into a bad market. What does that mean for borrowing? What does that mean for risk and delivery? What does that mean for exit? How would you tackle that, starting with Jack?
I would actually say I think a lot of our our investors have already made a decision that they're going to do what they're going to do before they come to us. So I have to do very little education. It's kind of like, we're doing X. It's typically like scheme led, right? So they're typically, rather than yours where they might do 10 projects with you, and it's very important what the macro markets are doing and what the economy is doing, because by the time they get to 10, the market might have moved. Whereas pretty much all of our investors come in for a deal, we turn that deal around, and then they're paid back, or we retain the asset, and then they can kind of reassess and rejudge. So there's definitely a lot less of us having to, I suppose, share that externally. But of the beauty of the podcast is we'll obviously share it with you. And I think that we're going to be moving as a business. I do think that real estate is getting, it's kind of like I was chatting to the contractor we're with yesterday. I mean, he's got 15-20 million pound turnover construction business, and we were talking about generally what it's like at the moment from my perspective and his perspective. And I said the problem what we have at the moment in private residential property development is everything is getting slower and more expensive. There's not one thing that's cheaper and quicker, not one thing at all. And that's been a downward trajectory since I've been in the game, which is a decade now, just over a decade. And that's making property development worse and worse and worse and worse and worse. There's actually easier ways to make capital and value. I think property is always going to be a good investment class, but to deliver what we deliver, which is developments, is getting more and more difficult. And everything's, I'm talking about securing a site and what you pay to buy a site and the land value expectations. I'm talking about the tax to get it bought. I'm talking about the planning costs, the planning timeframes, then obviously design costs, design timeframes, then compliance, fire, all of that costs have gone up, build have gone up. Sales hasn't improved significantly. It's not relative. So the costs haven't gone up relative to where the market's moved. So you're not basically coining in higher values in real estate at the moment to what the increase in costs are. Things are taking long to sell. Finance is more expensive throughout the whole project. And it's just more difficult. And as you say, the sort of geopolitics behind that is every country's printing more money. So I feel like it's going to be a pretty interesting next decade. I think it's going to be I think there's going to be more change than we expect, and I think that's driven also by AI, and also where I think some businesses are really going to struggle. But where I see opportunity is we talked about it, I think, on one of our ground up network calls. Like I think there's so much money to be made in being a service provider in anything to do with fire compliance, EPC, energy, in construction. I think that's a really, really booming market, and I think it will be for a while. I would love to do an exercise that if you built a really good CV for someone that's either like a specialist fire building control, a consultant. If you put that out in the market, I can guarantee you could get hired 50 times over on an amazing salary and hop and just keep going up and up in value.
Yeah, then the demand for fire consultants have gone through the roof in Wales, where there's just a waiting list for working with fire consultants.
So coming back to like where I would say the market is going, um, I think there's going to be a bit more blood on the streets, and it's going to be a bit of a dogfight, and it's going to be survival of the fittest. And typically, when it's survival of the fittest, it's cash reserves, stability, previous experience, and also funding lines. Fundamentally, is going to outperform everyone else.
Model as
Um,
well. I think the strategy you deploy is going to, or you employ, is going to be a big determining factor.
Yeah, completely agree. What we think is a really good space to be in at the moment is buying stock. And when I say stock, it's not just houses, it's blocks of existing landlords that own those assets in their personal name. They're being absolutely pinched at the moment. Obviously, there's new taxation coming in, secondary to all of the section taxes that have already come in. And I cannot see a landlord that has a mortgage, which is a lot. I know it's over 50% in the investment market space. I know that, but I think it's 52. I think it's 52%, or maybe even 60% of all the properties in the UK have a mortgage. Don't have a mortgage. So that obviously leaves 50% of the market that do. In the investment market space, because it's a commercial decision and people want to leverage their return on cash, it's a higher amount. So there's more mortgages on those properties. So if you take let's assume it's 70%. You take 70% of investment properties have a mortgage, and I would argue, a large percentage of those are personally owned. No one's making any money on those assets anymore. So what do? Do they just sit on it and wait and bail it out, or do they exit the market? And I think they'll be exiting the market, if I'm honest. So, so land doesn't fall into that category, really. There's not a lot of land that's owned in personal names where people need to get out, because the land doesn't typically have a high value or a mortgage. So I think there's a really good opportunity to get in on big assets where landlords need to get out, because it's just not making them any money anymore.
And Stu, what do you think of where the market might be going, where the opportunities?
2 weeks, we've had 2 opportunities that have turned up, which are off market, and these are people who have got huge land portfolios, or they've got farms and they've got buildings that they haven't got any money to do anything with. And I've asked actually one only a few days ago, I said, why would you not run this yourself? And they just haven't got the money to physically go through the planning. So I think even if in a world of even where nothing increases or devalues, adding value to land deals is something that we're looking into, because it's something that we can sort of bolt on the side of our business, spend a few hours a week and just, send it off to the consultants and third parties. And, it's lower risk. Well, it's higher risk, but higher return for an unstable market. It's something we can sell on or we can build out. But in terms of the reason I got into property development was, I've always wanted to do property development, but realizing through the pandemic that they can just print money at the push of a button, and the house prices, I disagree a little bit with everything you said was perfect, but apart from the house doesn't increase in value, it just sustains the value while they debase the money that you use to purchase.
No, it increases in pound amounts, but the pound is going down in
value. I don't think the value of property is actually going up too much. I think it's just
phenomenal.
If they're debasing the currency at 6 to 7%, to 10%, depending on where you are in the country, in the world, the value of the asset is just staying at the price it once was as they debase the asset. So having cash in the bank or not putting your money to work is becoming more and more, people are becoming more astute to the fact that their money is you can buy less tomorrow than you can today. So what's the point of saving? You might as well spend today, and that's the credit system we live in. So when I understood this in like 2020, 2021, I was like, right, I need to get as much cash. I don't want any cash at all in any banks. It needs to be either put to work or into property. And if I can, and then obviously once you realize that the currency debases, then debt becomes less powerful over time. So you want to increase your debt position as much as possible, because over time, that debt that once was, expensive debt gets cheaper and cheaper year on year. And property is one of the only assets that you can increase your debt position on. People will lend you against it. These big banks will lend you at 3, 4, 5, 6%. But if the money's debasing at 6, 7, 8, 9, 10%, I've never understood the model really, because their money is effectively debasing over time, becoming less powerful. So yeah, increasing your debt position, buying assets where someone will lend you money against it, is the play of the 19th, the 20th century. The 21st century, who knows? Will property become more of a utility again and not an asset? Who knows? But I'm hedging myself in both bets, and I feel like we're all pushing against the tide until you actually come out of the water and realize you can actually swim with the tide. And that is to invest in Bitcoin and to understand and spend the time on that. Then you realize that actually things are going down in value. Life gets a lot easier. And I've had a few people this week that have all reached out and said thanks to the Ground Up and from my passion, Rise passion, and from our education, what we're trying to say out there, that 2 or 3 people actually come and said that I've got into it now. So when we do our meetup, I'm actually going to spend my half an hour, whatever we get on stage, to talk about my journey in Bitcoin and actually why I got into it. No, I'm not going to try and preach to the choir. I'm not going to try and tell people to buy it. I'm just going to say what are the key bits in my journey to go penny drop moment, penny drop moment, penny drop moment, and then what actually gave me the conviction I've got in this what do you call it, parallel universe that I'm seen to be living in. And I feel like a duty to try and pass on as much of this knowledge or information that I've sort of been enlightened to as much, because the quicker everyone gets on this system, the quicker the power of the government and all this debasing that's actually ruining lives, causing so much civil unrest and problems, is all to do with the money, and it's all to do with the people who make the money make the laws. And the quicker we get away from the centralized world into the decentralized world, the better. And and our Bitcoiners believe in that, and we'll see what happens. But yeah, don't swim against the tide, swim with it.
Amen, sister. But just to clarify that point, because maybe I brushed over it too quick, the point being that asset prices, so property assets, will go up in denominated pound value. Doesn't mean they're going up in real term purchasing power value. It just means they're going up in an upward trajectory based on pound numbers. But the fixed debt amount doesn't go up in line with the asset the asset nominal appreciation. That stays as a fixed sum. So there's then this growing spread between the top line asset value and the fixed debt that you may have taken out many years ago, and that equity slice is the arbitrage, and that's a default way of making serious money. And to me, that's the strategy: is retain assets, consolidate, stabilize your debt position, make sure you can obviously fund the servicing of that debt, and then in 5-10 years you double your money and you've not even done fuck all. And that's ultimately how asset holders have gotten so rich.
To the uneducated investor, like with Section 24 and now with potentially employers and national insurance they're going to put on rent and stuff, they're trying to dampen that as well. So I mean, the governments are trying to not make it as an attractive proposition to invest in property, while in the meantime all the big guys are coming in and swooping up and taking it through businesses and swallowing up, where you're going to increase rents longer term as well. So it's not a bad business to be in buying and holding.
That's the main thing to do. The Granger Group, what do they have? Like a 4-month interval last year, their net rent position grew by 15% because of inflation, which is an upward pressure on rents. So not only do you have that growing spread between the equity position on the fixed debt and the top line asset value, you've also got inflation, which is a part of debasing the currency, pushing up wages, which inadvertently gets repriced into rents, and rents go up. So it's just a known way to make money if you obviously do it sensibly. I just think holding assets is the game. But D, what do you think? What do you think of this downturn we're likely heading into in the economy? How do you think investors should be thinking about that?
So the question was, what was the question? No, I'm joking. Yeah, so the short answer is I agree with all of you. And the only thing really I would add is that if you've got a trading business that genuinely you can more capital in and your rate of return isn't getting to the point where other opportunities are better, then double down in your trading business and keep growing it, because that is also a hedge against it's also an investment in growth. There's also a hedge against inflation. It's having a growing valuable business that keeps generating more money. So that's what my plan is.
Amen, sister.
Yeah, so a question I had for you, Ryan, is developers and landlords have a really bad reputation. I think the general consumer thinks that we're capitalists and that we're benefiting from the mortgage rates stay the same, capital values go up, rents go up, the cost of living goes up, so it's less affordable for what I would call the tenants, essentially, which are people. And my argument is, if the government taxed them less, we would be more affordable, and rents would suppress. So we wouldn't be such capitalists, and it's actually the government's problem, not our problem. We're opportunists and business owners and entrepreneurs, and we're trying to create value in the market. But I've had a chat with actually someone in my team, who thinks that we are, just greedy capitalists. So what's your view on that cycle? Is it the government's problem that's creating that picture, or is it our problem? Are we just taking advantage of the tenants?
We're trying to make a margin on the economic environment. That's what we're doing as business owners. We're just trying to make our margin on whatever the environment throws at us. If they want to repress rents, if they want to increase rents because of their environment, we have to make a margin on top. If we're living in a low tax environment where economic growth can happen organically, then actually people start competing for the business, so things come down in price. When you're up against the tide and you're trying to battle all these taxes and things being thrown at you left and right, you have to make a margin on top.
I think a really good point to make there is, if we just whacked on a greedy figure, we wouldn't rent our property.
Yeah.
So we're in competition equally, but I think I agree with you.
We're just trying to make a margin on top of staying in business. We've got to in business, you have to make a margin to survive. And if the environment is against us, then we're just trying to. We have to. Our margins get squeezed. They're not as nice as they once were. I'm guessing.
So it's funny because when you're out fundraising, especially in my type of business, which I class myself in the social sector, and a lot of investment funds I've met with, they call themselves social impact investors. So what that means is they want to get a return on the money, but they want to make a big social impact, positive impact. And there's a lot of social washing going on. So you'll have meetings with them and they're like, right, our number one priority is the social impact, and we just want a fair return. But then when you actually get into it and you start presenting them opportunities and deals and going into, right, this is what can make the biggest social impact, then start looking at it and then it's happened to me several times now. And then it ends up being that there's not enough profit in the deal, even though it provides a massive social impact. And it all comes back around to the origin of the source of the funds, the return requirement, the origin needs. There's a baseline plus the fees on top for other people for it to work their end. Where all of a sudden you now need a return of capital equivalent to a commercial deal, and you can't really do that whilst having a philanthropic type of social impact. Does that make sense? It just doesn't work.
They need to make a return. They'll lose cash, so the profit first, but profits first in every business. They're either disguising it as a social impact fund, which is their main drive forward to win business and to get funds in, but are not putting that as the number one thing. But ultimately, the money that they're putting to work has to make a return. Hopefully, it's a smaller margin than what a normal commercial business would want. But it's because of the debasement of currency. You can't invest in money knowing it's going to lose money, lose buying power over 5, 6, 7 years.
Well, I think there's a historic way to answer Jack's original question. If the layman was quizzing, are we these capitalists trying to exploit property as a way to make margin on what should be, a necessity, a human right, or whatever that they're trying to depict it as these days? Which I agree, a roof over your head should be something that is, very close to being a human right. I think human right takes it into a slightly grey area. But if you look back through history, why did this happen? How has this been allowed to happen? Well, the advent of the credit system through the 1900s into the 20th century, that's one of the first pillars. The second pillar came post-war, when there was a huge boom in government housing, which was council housing, and then past that up towards the Thatcher era, where that massively changed. And government housing, you can see it on a graph if you look back through those decades. And government housing, or social housing in that way, that was kind of distributed to the people, and you could have this sort of buyback. That stopped in the droves that it was, and it became more privatized. And ultimately, what's happened is the banking system, which is based on a credit system, needs to deploy capital at the fastest rate it can. That's how they make their money. That's the skewed incentive. We've now monetized the asset base. We've monetized property in a way, particularly in the UK, in a way that no other country really has. America has followed suit over the last sort of 50 years as well. But because we've monetized the asset base, what that means is the affordability, because in everyone's lives, your biggest expenditure is going to be your mortgage or your rent. They've managed to monetize that. And the more they can move that, even by the decimal points, the more they can get out the door based on the percentile that they get their money from at a cheap rate. And then they can kind of deploy into the housing sector. So it's become this huge asset base for banks to be able to exploit. Even if it is just a few percentile, the more assets increase, the more M2 money supply increases. And it comes down to how much can we push the consumer based on the affordability they have on their income against the highest expenditure they have, which is rent or mortgage. And I think those are big macro plays that none of us had anything to do with. We're just playing off of what are now, you could call them skewed incentives, where the asset class is monetized. And if people don't like that, well, they need to speak to government and the banking institutions, not the participators like us.
They point the finger at us and go, "You." But the big problem I have is they point the finger at us. But what about pointing the finger at all of the supermarkets that had their biggest years through COVID when people needed food and water? That's exploitation, in my opinion. What about the energy companies that have gone up 180% when we've put up our rents? Even Ryan said in worst case, 15% in a quarter. Some heating bills have gone up that much, and the government were, not helping to subsidize that and letting old people, catch a cold to death.
Just thinking from a common sense perspective, which had come to me this week, if I had £100 billion in a business and I'm one of these big companies in the UK, and I go and say, right, I'm going to go and buy a 30-year gilt, right, I'm going to pay you 5.7%, it's increased, but I'm going to give that directly to the government for them to spend in the country. Do you think I'd have a seat at the table if I said, well, I'm going to buy these gilts, I'm going to buy them, I'm going to invest my money into the government? Do you think I'd persuade them to spend a percentage of that in a business or in a part of the turning of policies to help my business? How much do you reckon I have to buy in government debt to have a seat at the table, by influencing the way they make decisions?
Fucking all of it, mate, because they still won't listen to you.
Well, I think think tanks and stuff are all of the repercussions of big money coming in to having persuasion on how the government spend money. So what Jack just said there, exactly right. All these grocers and energy bills are companies that made a load of money during the pandemic, all the health supplies and all this other shit that they made money on. Why wasn't that just a neutral year where costs were covered and not exploited? It's because the people who have all the money, who are going to spend the money with those companies, all have a seat at the table. They're all part of think tanks and stuff that influence the government. And that's just how it's just been built over hundreds and hundreds of years. And as their pots grow bigger and bigger, the power gets bigger and bigger, and they make bigger decisions. And, us mere mortals live in their world, unfortunately.
This is that issue of the revolving door, though, isn't it? It's a revolving door of the political class and the incumbents or the multinationals. It's why we have to have a different system. We have to have a transparent system. It's so opaque. Like they've all the other things they've done, of making central banks independent. A load of the insurance companies took a load of money from the treasury, and that's now now they no longer need to disclose those amounts. Like, these are shady things happening to the taxpayer. And we have no purview on those things. And I think it all trends in the wrong direction, where the incumbent benefits. So I don't blame the supermarkets for making sky high profits during COVID. I blame the government facilitating that scenario happening in the first place, because it all stems from government mismanagement.
Don't believe anything else. Keir Starmer and his fucking merry men are a bunch of idiots. And they're all just puppeteers. They're the front people being told what to say and do.
But it's government as an institution, as a structure, to manage the people. That's what I'm blaming. It's just the structure's broken. The people within it, yeah, they can be good and bad. There can be people with good intentions as well, who are trying hard, but they're up against what's been a devolution of government power from Parliament and the House of Lords to quangos and these kind of third parties that aren't voted or elected, and they can make permanent decisions. And that's what needs to be reconsolidated back into parliamentary power, so we can vote in decisions that we want to be changed and hold accountable the elected. That's the issue. It's that structure that's broken, and allows multinationals to exploit it with a revolving door. Do me a favor in there, boys, and you can come here, sit on the board, make 500 grand a year. And that just keeps happening and keeps happening. It's rotten. It's rotten to the core. And it's happened in Europe. It's happened in America. And I think that's where a lot of this revolutionary rhetoric's happening now, and the Civil War stuff is really what they're fighting against. Is that it's not actually immigrants. It's not actually this and that. Those are all symptoms of a rotten structure that's somehow infiltrated all of society, and it's probably just bad incentives, and the money prints are a concoction of bad things that came in during the 20th century and are playing out now. And Blair and Brown both had big things to do with devolving that power from government. And unfortunately, Thatcher did as well. She didn't mean to, but she created the NGOs. And she thought that was a good way to devolve power from central government and have independent industries manage themselves with domain experts at the top. She thought that'd be a better way to have autonomy within given sectors. What ended up happening is over the preceding decade and 2-3 decades, those NGOs got taken over and completely exploited because the incumbents ended up using that revolving door system to control the NGOs, and then the media controlled the NGOs, and they really became hostile. But she didn't mean to do that. It's just you do something at the top if the incentives structures aren't healthy, then there's bad actors who will exploit them. And we need to change all that. What would you say then? So the first question was, we're heading into a bad market. What would you say to investors? What are investors' options? If I've got 250 grand in the bank, what can I really do to make a meaningful return over the next?
Can I guess Stuart's answer?
No,
Go on.
let's leave it out. Let's leave that out. I mean, my scaffold had the same issue. They're making profits. They're sitting on about 200 grand. And he's like, him and his business partner are stuck. Do we go and buy a property in Spain? Do we buy more scaffolding? Do we increase our yard? What do we do with our profit? And he asked me that yesterday. Do you know what my answer was?
Bitcoin?
Take half of it, hedge your bets, study Bitcoin. That was one of them, yeah. Or give me money and I'll give you a standard 10% and I'll put it to work.
What would you say, looking at the options that you've got out there? Obviously, there's stock markets, there's commodities, there's gold, Bitcoin, there's savings accounts, there's property. What would you say to some? So you said half in Bitcoin. Where's the other half going?
Into property. Yeah, you see, create passive income. If you're not going to increase your business, which obviously Dorian's in high growth mode, and you're happy with the size of business you've got, now you're starting to make profits and reap your reward. What do you do with the cash? The one thing you don't do is leave your money and just forget about it, because it's going to debase over months and years. Inevitably, it almost guaranteed. It's certainly going to lose value daily. So you need to put it with people like us and invest your money to make a healthy return. Invest in equity where you can create smaller, income producing assets, or study Bitcoin. Obviously, I'm very much into both. I got into this game because I wanted to create the assets, increase my debt position in this world. So that debase is almost certainly create a positive income, whether it's £1,000 or £100,000. Take that money, buy my food, pay my mortgage, and then invest in Bitcoin. And that's the whole ecosystem of what I'm trying to do to create wealth over the next 10 years. We'll see. There's nothing else I can see. And I passionately love trying to work out ways of making money. I can't see any other alternative to doing that.
I am really sorry, but I've got to
Okay.
shoot because I've got to do the school run. So I was just waiting for the opportune time. But guys,
Congrats on the award, mate.
Thanks again.
Journey home with us, mate. It was lovely to watch you drive.
Yeah,
Didn't tap on the steering wheel or any songs, but yeah, we'll see you next week.
yeah. See you soon. Have a good week.
Safe on, big man.
Yeah, bud.
See you, mate.
Jack?
I can dive in. Yeah.
Go on.
So 200k just in the bank account. So the first exercise that I would do if I had £200,000 in the bank account is I would go through everything that I personally have potentially on finance, look at what that cost of finance is. And if I think it outperforms any return I can get in the market, I'd pay that down. I would then be almost on a mission to find out one of two things. What my risk appetite is for that capital. So let's say, for an example, your mortgage is paid off, you've got a very successful business, you've already got a topped up pension. Your risk appetite for that 200k would be a lot less risk averse than if you only have 200k and you're 58 years old and you're coming towards the end of your career. I think that has two very different aspects on investing that capital into a safe place, and also potentially instant access if you need it. So one, test your risk appetite. Once you understand your risk appetite, build a pool of ideas that complement that risk appetite. So if it is your last pension pot, it might be a good idea to put it into a small buy-to-let property, hold some capital back, but then get a residual income from the rental property and be able to sell that if you needed to. or potentially, you know, like a commercial asset, buy 150 grand retail shop on a 10-year lease, full repairing, getting 10% a year in a secondary market town, and you're kind of taken care of from that respect. So that's what I would personally do. A second exercise that I would do is, in that risk appetite market, work out what your compounding IRR is. A lot of investors negate the compounding value. So, for example, if you've invested something over 10 years and it's 10% a year, but you don't get the cash back every year, your return over that 10 years is going to be surmountably different to if you get the cash back and reinvest that capital every year. And I personally would be looking into also treating it a bit like a portfolio. So Stu's mentioned Bitcoin. You might look a little bit into ISAs. You might look a little bit into your pension if that isn't topped up. You might look at potentially investing a small amount into a startup business. You might look at investing some into real estate and splitting that pot up accordingly to, one, your risk appetite, but also your return requirements. And it's almost like, I haven't answered the question, what would you put it in? Because if my nan asked me that question and a 16-year-old asked me that question, it's two very different answers. If a 16-year-old asked me that question, I would plow 50 grand of that into your own education and setting your career up to a position so you can maximize and monopolize the value of that capital. My nan asked me, I'm just going to be like, fucking go and spunk it on a cruise. Like, I don't like, you know, it's two very different answers. So it's very difficult to answer that question without understanding the background of a person. But I think we can all agree that it's sensible to look into, you know, things that could potentially outstrip inflation, which for Stu's joy, that could be Bitcoin. It could be real estate. It could be a business that works in real estate. And all I would say is speak to 5 people that you know invest money in something, and then analyze it, because I know a lot of people that just have it sat there or don't know what they're doing with it, or you know, like, fucking kills me that my mum's got fucking premium bonds or whatever, where she gets like a prize return. I'm like, fucking hell.
Yeah. I mean, I would say if I was going to tick off the asset classes, you know, because the average Joe, they're going to think of stock market. Well, stock market in the current day has never been more volatile. You've got the advent of AI that's debasing costs globally. You've then got tariff wars between the West and Asia. You've then got complete reconsolidation of the manufacturing and supply chain, which is, again, just changing up the different macro dynamics between stock markets around the world. So I think there's too much unknown there, unless you really know what you're doing to make any meaningful returns. I think, you know, you're better off just putting your money in the S&P and being passive, which is what, a 14% annualized return over a very long period.
The S&P obviously tracks the best performing companies, and it is constantly changing. So I do believe that that is a really secure market, like you say, Ryan, for a layman to just actually go in and trust without having to hedge bets and you know, worry about that.
And then you've got commodities. Commodities, you can be a very passive way to make money if you know what you're doing, you know, and if you don't know what you're doing, just don't touch commodities. Then you've got gold and Bitcoin, which are good pound proxies. And I do think it's a good way to hedge your bets in terms of preserving purchasing power, but you can't leverage them the way you can with property, which I think is a big, you can in a roundabout way, but not in the lucrative way you can with property at such a cheap rate for such a high LTV to recycle. All right, we'll compare the difference.
That's level 3. Once you get to the point of actually understanding what Bitcoin is, if you measure all those other assets against Bitcoin on a graph, and you treat gold versus Bitcoin, stocks versus Bitcoin, S&P versus Bitcoin, everything is going down, because Bitcoin is a monetary system that's absolutely showing every other asset you can invest in is going down against Bitcoin, and it's certain. It's $111,000. You know, when we started this podcast, it's gone up 500% since I've been buying it. Yes, it's volatile up to the upside, but because you've been in it, as long as you're in it for longer than 4 years, you're guaranteed to make 3, 4. Almost, you're guaranteed. There's no other answer now. 16 years is the best performing asset.
Stu, I think, can I outline from my perspective what I think the biggest issue of Bitcoin is? It's not that people don't believe it's going up; it's people don't believe it. So the problem with that is 100% of nothing is nothing. So what people's perception is, it could be going. It's almost like. Have you ever heard the phrase, "Don't sell it too good because people won't believe it's true"? I feel like that is where the public, and I was part of that public, feel that it just isn't a thing. It's too fairy dust. It's not like an actual thing that people know, like, and trust. It's a bit like, for an example, the change in. I watched the highly recommend it actually. I watched the BlackBerry movie the other day. It's really, really good, really well made, and very interesting to watch.
About BlackBerry.
It. Sorry.
About the company BlackBerry.
Yeah.
Yeah.
How it went from being the it was the highest sold mobile phone in the world for a duration. Then the iPhone took over. But this is a principle I'm getting at. The Bitcoin money and cash is the buttons on the screen, and
Mhm.
Bitcoin is no buttons. When it first came out, everyone was like, "That's never going to work. People want to hear a click. People want to press a button." And then, like that, it went overnight, and
Yeah.
everyone flipped. And I feel that's a very quick market. Like, that probably happened over 6 months, whereas Bitcoin's probably 20 years for that to flip, for that flip to go, actually, Bitcoin's where we want to be, and cash isn't. But the principle I'm getting at is your sale is going up 1,000%. If you did that over this year, is going up. But the education needs to be, this is why it is a thing. This is why you can rely on this cash.
I agree with you, mate. That is the layman has that issue. Is what is it though? Like, I understand it's gone up loads, but
Discovery is the number one thing there. People aren't going to do everyone's homework for them. They're going to have to go on a journey of self-discovery, open a book, read some stuff, and just take the knowledge in. People will buy Bitcoin at the price they deserve, but I believe it's going to $13 million a coin by 2045. Right, that's basically the trajectory of everything I've learned. That's where it's going. So whether it goes up and then down 50% tomorrow, people can't stomach that and go, "Oh my God, I've lost money." But what I was saying, if you stay in it for longer than 4 years, you'd erode through enough volatility where you are actually in the up, and then you can start borrowing against it. The fact is that no one understands. At the end of the day, now stable coins is becoming a law, effectively, that other countries outside of America can start trading in the dollar, which everyone wants the dollar, to download a digital wallet to use the dollar, which the governments and institutions are going to want to push to educate people because it's a cheaper way of creating more dollars and for the dollar to stay in power. Then once you've understood and you taught the world how to download a digital wallet, you are one click away from turning it from digital dollars into digital Bitcoin. And that's the catalyst that's going to spark where it happens gradually and then suddenly. And that's really where we're going to go. And it'll crash by 2026 from 400,000 down to $90,000, and the world will be over again, like it's done over the last 4 cycles. So I just think that there's a lot of stuff going on. When you've got Blackwater buying, you've got governments who are all they haven't got enough Bitcoin. They need to keep the suppression there to start collecting and understand this thing is totally scarce. An email isn't digital. You can't touch an email, but we all value emails. Digital music isn't. You can't touch it.
Email, yeah, but that's all experience or communication. It's not an asset. So, like, if let's put the frame in mind. Let's say someone came up to you in the street 30 years ago and said, "Do you want to buy this thing that isn't a thing you can see or touch? You can trade it. Would you want to buy it for 20 quid?" And that people are going, "No, I don't want it for 20 quid."
Facebook's exactly that. 20 years
It's not an
ago,
asset.
we're going to share this stuff. We're going to share photos and emails.
Yeah,
that's got value.
communication, isn't it? It's not an
It's
asset.
got
So,
value. The
Data
transfer of
has
money
the
from
value.
at point A to point B, peer to peer, for me to send you something over the internet, for you to send me back about any other beneficiary or anyone else or any fee taker, is the value. The fact is that we all believe that these stones in 2,000 years ago had a value, that if I hold the stones, had the power and I've worked hard for it. And if I give them to you, you now own that power, and which everyone believes in. That's the same as what government money is in fiat, is that we all believe that these pound notes have got some value, and we all work and exchange them for good to go. It just takes time. For every 50 years to 100 years, the currency of today dies out and the new currency of the future. The fact is the next one is the biggest, hardest, the best asset we've ever created as humanity. That's going to win. And it's winning. It's $111,000. I mean, the number is its only marketing tool. There's no board of directors going, right, I think we need to advertise in Vegas. We need to stick this on the billboards. This is believers of people the last 16 years that it's just getting like, it's just getting stronger and stronger and stronger. And that's why I can sit here over 5 years now, just confidently know that in the next 5 years, this thing is going to change the way that we transact as humans with each other, outside
I
of government
I
power.
don't disagree with that. I don't.
And let's go, baby. And the quicker everyone who's listening to this realizes that and starts their own journey on discovery of Bitcoin, the quicker they'll be able to thank me and send me the boat in the post in 5 years' time, because it's coming.
It is coming, mate, and I completely agree. But I think if I was to hedge my bets, because I agree with you that I think you should be leveraging pound proxies like property, but where there's scarcity, leverage the pounds you can at cheap debt, and then use those pounds to keep compounding that growth and buy Bitcoin with the rental proceeds. And you're basically then leveraging a depreciating and shit asset class, which is a fiat currency system, to its absolute hilt through a really commonly understood and leverageable asset class like property, and you're then proxying back into Bitcoin, which is a much stronger asset class. But you can do, I think by doing both, you can kind of make an infinite pot. Whereas if you just bought Bitcoin and had the bets on leveraging Bitcoin at a cheap rate at some point in the future, I think you could miss quite a lot of upside. I think.
Only problem is property doesn't go up at 60% year on year on average, which Bitcoin does. Now, whether it goes up 60% and then institutions get in, it gets to 1 million to 1.5 to 2 million, and it jumps to 30% year on year, you still can't make the same returns. Bitcoin does win against everything. The problem is you need to create cash flow to buy more Bitcoin, because if you start on zero, that's why you need to do both. You need to buy property, create income producing assets. Buying and selling property, I think,
But leveraging the pound as well, though,
good.
and doing like if you didn't get a mortgage, right, it wouldn't really be worth it. But it's the
But you have
mortgage
to leverage
part.
that. You have
Yeah,
to increase your debt position.
leverage
That's the key.
returns is how it works. Yeah,
You're playing in both worlds. You're betting on the certainty of the debasement of currency, because they have to, and you're betting on something that's scarce, that's going up. It that mirrors it. So you're basically increasing this position. It's almost like an accelerated way to wealth. And obviously, I'm not wealthy, and I don't absolutely think I'm anywhere near wealthy. But I think the trajectory of what I've set, being 40 into my 50s, should set me for life if it plays off. And obviously, we're living this debt bubble you said about, obviously, Theresa May, and in the 70s, that was all the spark of all these government, all these council houses, was because they opened up the doors of borrowing money. This was the start of borrowing more money to pay for this stuff. And we can't control the purchase price, and we can't control the value of the assets. And if anything happens with the currency these things are traded in, then we're all vulnerable. But when you learn all this and you realize, actually, if house prices were to crash 50% or go up 5x overnight because of uncertainty, the one thing I can be certain about is there's only 21 million Bitcoin, and whatever happens to the market, and if they print a load of money to save the old economy, Bitcoin on the other side is going to go like a rocket ship. And that's the difference, is that, once you get into crypto, I'm not going to wake up one day and go, I've had enough of this game. I'm bored of it now. I'm moving on to, let's go back to buying the pound. It doesn't happen. It's a one-way gate once you understand it. And you've got millions of people now. You've got 500 million people around the world who understand it, that are just like me, who are just, these aren't, I'm not brainwashed. I don't benefit anything apart from getting more people on the system so I can actually start transacting and living my life in the Bitcoin world.
Just to let everyone know that's listening, before we came on this episode, Stuart said, I haven't got anything to talk about today.
well, I'll talk about Bitcoin.
I'm in heavy trade mode, so I'm just Skylofts for the next few weeks. But yeah, no, you're right.
Go on, what does that mean, Stu? Give us some insight. Why are you heavy trade mode?
Meg's off. I've got 11 days left. I'm off to Disneyland next week, and then I'm off the Dorian's golfing trip the week after. So it's head down, bum up, get on with it, and just get on and get as far in advance as I can, really, and then ready to react when the first 4 weeks of Meg going is going to be painful, because she does so much. And it's when you take, I need when she's out of the job, I can then see all the gaps and cracks I need to catch. So
Yeah,
I might go a bit quiet for a month on socials and stuff, but needs must. I need to protect the principle, which is Skyloss, which I'm so glad we've got high frequency, high fast pounds that allows me to react so quickly. So that's why I'm focused on Skyloss and our lovely customers, of course.
how'd you get on with Alfie in the end?
Yeah, good. Yeah, he's really good. Like, he got one more year at college, so yeah. So he works down at the Lido, because he said he has 3 jobs. He had the Lido, he had the river, he had the lake job, and then he had fish and chip shop. Thank you, Charlotte. He's listening in through my door. Fish and chip shop. So yeah, he's just a little grafter, and he's very charismatic, lovely to speak to customers. He was on holiday when the episode come out, so I sent him the link, and he already his girlfriend is my cousin's daughter, so he's a bit of a long relationship line. But yeah, he already watched it, and he was very thankful that it was on it and stuff. And yeah, good lad. So we'll see. I think he's going to do a few more days between now and Christmas, with a view of coming in and taking something on from us once he I told him not to bother going to uni. I think it's a complete waste of money and waste of time to get out there. If you want to understand business, get in the mud and get on with it. That's how you learn business.
I will say that I was thankful I went to university because I probably learned a lot of other life skills outside of just business and education, like living in a house, moving away from home, maturing a little bit, having a little bit of a blowout. I do think there is other benefits to education. I think the cost of it now is ridiculous, like 48 grand for a standard university in the UK. And it's actually a bit of a trick. When I got into university, the way that they pitch the student loan is that you don't pay interest on it, and you do, right? It's complete bullshit. They push you into it. So I would say there's other things you can gain, and lifelong friends. Like some of my friends from uni, I met through uni, and they were my groomsmen, and I value that as well.
See, I think it's a waste of 4 years. I think that 4 years in the mud.
Yeah, but the thing is, I was grafting just as much outside of uni as I was in.
Is that the typical case though? Most people don't, right?
I think that's inevitable. If you want to be a business owner, you got to start young.
Yeah, I think if you want to be a business owner, yes, but if you've got aspirations to just want to be a good worker or support a company or do something, because a lot of people have a lot of ambition, just don't want the risk of owning their own company, or they don't have the necessary aptitudes or skill sets or the fortune to actually make it work. And for those people going into uni, I think they should be really thinking about what they're studying, because I think you can build long-lasting relationships. You can have a great social life in a workplace as well, if it's a good workplace. So I think you can learn some of those things. And I think the 4 years, I tend to agree with Stu that 4 years is massively wasted in certain.
Just to educate both of you, it's actually 3 years you go to university for.
I didn't go uni, mate. So
It's
you got to do
3 years.
college, all that shit as well, isn't it?
If you
I mean,
do a placement year, yeah, it's 4.
Well, I mean, you can go up to 8 years, can't you? It depends on what you're studying. And if you're going to be a surgeon or a doctor and stuff, yeah, totally. You
Yeah,
need to go and
yeah.
be around those type of people. But if you want to be a grafter and run a business of some sort, you got to understand cash flow forecasts, be around paying debt,
Or
understanding how it works.
Or Stu, if you just don't know what you're doing, which is like 99% of people who go into uni, they're just like, I don't know what I want to do, so I just picked a uni course. It's like, well, then go into the workplace and just move about a bit, or get an internship. Like, that's what you should do. That's how you'll really figure out what you want to do. By the time you'd have finished uni, if you'd have spent that time in the workplace, you'll know what kind of person you are. You got good aptitudes for sales, as an admin, as a finance person, as a whatever. Then you're probably better off going to uni and doubling down on a course where you've already found real world experience is something you enjoy doing. I just think it's so backward.
It's a big decision, because I feel that in the workplace you can move roles really easily. You can move different industries, different companies, different experiences, different positions, but you only get one shot to ever do uni at that age, and
You can do it when you're older. At that age, it's basically, do you want to extend your social life for 4 years? Do you want to delay getting on with life for 3 years, or do you want to crack on? But you're talking to two people who did go to uni, so
yeah. I'm just making sure that if there are any, anyone what year is it, 16 to 18-year-olds thinking about potentially uni, I feel that my degree was a bit of waste of time for what I ended up doing. It was business and marketing, and it was too marketing heavy, and I actually didn't enjoy the degree that much, and picked a lot more accounting modules. So I actually regret the type of degree I did rather than actually doing a degree, because I got my fix in, work outside of. I worked, I had a job back in Henley, and I had a job in Oxford when I was at Brooks. So I feel like I developed as a potential business owner in that period quite well. So I just say, I do think it is an important decision, and we can't just say, you can say I think it's a waste of time, but I also want to say I do think you need to give it a lot of thought and make sure that if you are making that decision, because you won't get that decision back. It's easy for me to go, I'm going to go for a career change or open up a different type of business when I'm 25, but it's very difficult to go back and get that life back and do uni. So I do think it is an important decision. What I would recommend, that I think the best way to go to university, which my mate did, and I've always ever been jealous of, is he did an engineering degree, but he worked in a company that then paid for his degree, and he then made sure he socialized like he would if he was at uni every day, but he was actually in a business working a few days a week, and then in uni learning a few days a week, and it was paid for. So when he left, he had money in his bank account because he was working and earning. He had a degree, and he had the social aspect to it as well.
Was he like fucking good though? Like, as in, like the company was willing to pay for him because he was really good.
He was like one of the main leading car manufacturers. He was just a
it?
standard engineer. Yeah, I mean, everyone else runs out of uni with a load of debt, and whereas he was just
He's-
already sort of coming out with the experience and the cash.
Yeah. I mean, there's so many ways to do it. I mean, my little brothers, I think it does just depend on your circumstance. Like for my little brothers, it was a choice of, do you want to go to uni after college or do you want to come work for the business? And they just never saw uni as something they'd want to do. So they're straight into the workplace and they'll learn things over the next few years that they could just never learn at uni. But I do put pressure on them to go, don't forget your mates though. Go see girls, go party, go get drunk, like do that shit, because I think that is, back to your previous point, Jack, there are things you get out of uni life that, you may look at academically and go, you bummed around, but actually you built really good social bonds. You learned a lot of independence. You learned what not to do and how to blow out and get those out the way in the early years with your peer group, as opposed to being a senior and coming back. Because I agree, that would be, you don't want to be 35 and going back into uni with a load of 20-year-olds. But there's something to be said about bumming around in that way, as long as you're somewhat applying yourself, but just being around mates and your peer group, because kids don't do that enough nowadays, period. And if they just focus on work, then that's not necessarily good
No.
for the workplace long term either. So there is a balance. I just don't know. We're in a weird world, man. Like, because how valuable is uni anyway with now ChatGPT and other things? You can go and learn any domain topic to like a PhD degree, at a click of a button. So it's just kind of like, what is worth a kid's time? I would say to a kid, if you've not got any clarity on what it is you want to do or want to be, then just get into work and just start contributing and start making money, because that's going to likely pay off better over the next 5 years than gambling on there being a job market for you in a given field you're studying for now. Because I don't think that's any more guaranteed.
I think the best thing you can do is from the age of 15, every summer do work experience for various different people that run businesses, big companies, small companies, medium companies. Some of those have degrees, some of those haven't got degrees. And just by the time you become 17, 18, understand a little bit more about what you want to do.
Amen, sister. So you did. I didn't realize you didn't go uni, Stu. So did you drop out of school? Did you
I
leave
dropped out of
school?
college. Yeah, I dropped out of college with an opportunity to work directly from an owner who was running a small off conversion company, and that set it could have, my cousin was working for him. He seemed to like him. They had a bit of a social thing with work, and he was growing this thing and sold me the big plan, which I bought into. And I could work directly next to him. I could see the creditors. I could see the invoices coming in. I could see decisions he was making daily, and and admired him. Thought, fair play. He's
It's
having a
cool.
go.
It's cool you say that, because obviously that's, looking back, obviously those have been really formative, valuable things for you to be exposed to that young, that obviously helped you with that transparency later. And I feel like that's what we're giving to young guys who work with us now. Like
Well, I'd done a year and a half at college, and I realised that all the modules I'd done today were all technical roles. I didn't know what the words were then. I didn't know that technicians, managerials, entrepreneurial, different mindsets. But when I realised how to work AutoCAD, I was like, yeah, great, I understand it, got it. Next one, yeah, how to do QS, how to read the red book, how to work out the cost, yeah, got it. Materials and stuff I was working with B&Q. So all this stuff was sort of coming together in the construction world. I was just exposed to bits of it. And to be honest, I'm still exposed to the development cycle is a fairly new way of thinking for me. And yet every single thing I learn, whether it's from health and safety or through costing these jobs or from project management side, I think it all falls down to common sense. The whole way it's been built, it's just there's so many elements of it. If I went to uni, I would have learnt these bits from a educational standpoint and then applied it to business. But I think most of my decisions, if I weigh up the decisions I made, they are made from experience. And I think from most decisions I make is from being burnt before or failing fast previously. I would say 90% of my decisions are from experience and 10% is from the educational piece. Because I just missed the educational piece. I've had to learn
I also
the hard way.
I also think there's like an ornate capabilities in people as well, though. Like you can just, I see it in, we have quite a few interns who work with us, and some of them I look at it and I go, they've got it. And others I go, they need to learn it or experience it to have it. But I feel that there's a lot of, like you said, common sense that you naturally have pragmatic people. I'll often get a mate ring me and be like, what would you do in this situation, that runs a business? And I'm like, how did you not come up with that idea yourself? Like, to me, that just seems so obvious. I don't even know his business inside out, and I know that that's probably a good idea to do that. So, it's like problem solving. Some people have an ornate, and I think it comes from like the early adaptation of your brain of like being able to problem solve and do more and more and more of it, and then like start getting, be fascinated by it.
And to be honest, I mean, you have mental blocks when you're in the business or you're in the weeds so deep. It's so difficult to see the answer. Where I'll ask someone like my dad or my cousins are really successful, and if I've got a problem, I'll be like, "This is what I'm up against." I mean, I'm against the wall, and then you just get this different angle to go. Well, we just do this, and this could happen. It's like, oh,
Mhm.
you're absolutely right, and then it just opens up these new doors. So yeah, asking people with experience is important. And I'm not against uni. I think the social life is fucking brilliant. Go and enjoy yourself and do a few years. If you want to delay, the end goal is to be successful and to have time freedom, location freedom, family freedom, and all these things. And if you're willing to delay it potentially for 3 years or longer, in a field that you're not 100% certain with, and I mean, Jack, you're the only one on here, but we've got 100% success rate of someone saying they don't enjoy their university degree. I think we asked 1,000 people if they enjoyed their university subject. 80% of them would probably say, nah, wrong subject. Great, I love this uni and I've got best friends for life. But actually, to try and get to the wealth direction, it's probably delayed 80% of the 1,000 that made the decision to go to uni, where I've only got experience from building up experience. Those 3 or 4 years, you're coming out against someone who's got a university degree with the common sense bit missing, like the real life practical decisions that have to be made. And they're to me are more valuable in
Nowadays, entitlement.
entitlement.
As in, I've got a
That's
uni
like-
degree, I should get a job. Do you know what I mean? Which is not necessarily true anymore.
Yeah, I think that's flips on its head. I mean, I know a friend of mine's mum runs like an audio company where they like do the audio scripts for books, and pretty much all of her employees are Oxford graduates on like 26 grand a year.
Mad.
Fucking mental. Like one of the best universities in the world,
Yeah.
and they're on like minimum wage.
Making an admin
Crazy.
wage. Yeah.
Yeah.
Just quickly on Alpi, I don't think I would have wasted 2 days of my life with someone who just like, I'm going to uni, don't really know what I want to do. Like the fact he's already grafted and he wants to do something in business. He doesn't know what part of business, doesn't know what he wants. He wants to go and buy a lake now and do his own thing because he sees the opportunity there in the pound. But he just gets it. He got 17 years old. He understands the cash flow. He
It's smart
understands.
now.
I was talking to him like I was talking to a 40-year-old, not like my ageist thing. I couldn't care how old someone is, but I could talk to him about a real life problem or something I've just heard or a phone call and talk through the scenario in my mind mentally as what experience brings you. And yet he was getting the answer. I was like, you've got it. You've 100% got it. You just need to choose whatever you want to do now, whatever you want to do for 30 years of your life, aim for that as your goal, and then go and work for anyone you need to and go and learn all the skill sets around aiming to that end goal. And I think if that was the educational system of the 16-year-olds of today, 80% of them wouldn't go to university. They'd go and follow that road.
I think if you look at The Apprentice, and all the exercises they do on that, they give them a product and they've got to launch it to market. They put them on a market stand, so they've got to sell sweets. They make them, go into difficult situations and difficult interviews. That should be a module in university. That in business context, that should, I was getting told by some old lady that's never run a business how Coca-Cola does their marketing strategy this year. And I was just sat there thinking, I don't want to work for Coca-Cola. This is fucking completely irrelevant to me. And I want to understand, I want to be put on site with, I want to go in independent shops like a bakery, see how he runs his bakery, see what's good, bad, and ugly, see where his challenges are, see where he gets pushed. It might be staffing, it might be, his issue might be waste, product waste. That's a different issue to our business. We don't have any product waste. Our surveying business has zero product waste.
Or construction.
So like comparing all those different SME businesses is what would have fascinated me, but you just learn about book stuff and listen to someone that hasn't run a business and then bollock you that you're not paying attention.
Yeah, it's been a good episode, guys. And again, just a reminder for anyone that we are doing a go-karting networking event coming up in November, and you can check the link in the description to access our website, and you can get tickets from there. This is going to be a good day, chin wagging, having some fun, go for dinner, do some go-karting. So come along. Anyone's welcome. It'll be a fun little experience in London. And big love. Thank you for watching and subscribe. Helps us to subscribe, turn on the bell notifications, share the episode with anyone who you think may find it useful. And we'll see you
Subsqualor.
next week. Subsqualor.
Ground up sound. Ooh, yeah. Real estate deal. We lay 'em